a little bit of the introduction about the point values, but I don't think that's real critical information. So we're going to start out here in chapter one, module one, chapter two, module one, talking about quality control. Now, what happens? You go through all this work, taking the classes, getting the units you need to sit for the CPA exam, plan, study for and pass the exam, get your experience. You work for a firm, you get some nice experience, you decide, hey, I'm going to open up my own firm. And the last thing you want is for that, rocket ship that's going forward and upward to be knocked down by some sort of problem with the quality of your audit. So what you're going to do is you're going to set up a system of quality control for your CPA firm so that the audits will be done according to standard. So one of the first things we want to try to understand right here is, well, are quality control standards different than the standards that we use to conduct the audit? The answer is yes. Quality control standards talk about how the firm should be structured to ensure that the audits follow the generally accepted auditing standards. Okay, so what's happened is the AICPA, American Institute of Certified Public Accountants, has put together a code of professional conduct, and part of that code will include statements on quality control standards that are issued to tell us how we should structure our CPA firm. So one of the key things here, and you know that I don't always believe in the mnemonics, but I like them when they kind of just spell a word or a phrase. Okay, so this is going to spell out help me. Okay, help me ensure that my audits follow standard. How will I structure my firm? Okay, so we're going to see that we're going to have human resource implications, client acceptance implications, who's going to take the leadership for all this, how are we going to ensure that our engagements actually follow the standards, what will we do to monitor to make sure that indeed our quality control system is working, and then what are some of the ethical requirements. And we're going to get into each one of these below. I'm going to call out a series of flashcards for you, and you're going to want to make those flashcards so that you get a couple multiple choice questions on this. You will keep this area as easy as it is. So go ahead and start out by flashcarding the elements of the quality control following that help me mnemonic. Okay, so let's start with the H in help me. Let's talk about human resources. And of course, one of the key things that human resources does is recruit, hire, retain individuals, etc. Okay, so what happens in order to ensure that our engagements are going to follow standard, we want to hire people that possess certain qualities, certain qualifications, etc. So we want to hire those that have the appropriate characteristics to enable them to perform competently. Okay, now the approach that I take with this section, guys, is I ask you to flashcard the activities that will help accomplish the objectives under the different parts of the quality control standards. And that tends to be the way they write the questions. They say, which of the following would help ensure that the firm follows quality control standards? And it's either going to be one of the help me's at a high level, or they'll get into these specific types of activities, such as requiring timely identification of staffing needs. You know, you don't want to rush out there the night before you need more staff, because then it doesn't give you the proper time and resources you need to vet individuals that you're bringing into the firm. So timely identification of staffing requirements, planning for the total personnel needs of the firm, requiring background check on new personnel. Make no mistake, when you go into work for a CPA firm, they will run a report not only to see if you're ever convicted, and they ask all those kinds of things, they also run something called a Pinkerton Report. The Pinkerton Report asks if you were ever even arrested. So they do pretty thorough background checks, particularly if you're going to be in more sensitive areas. I know that for when I was looking at how IRS brings in temporary staff during tax season, when I was with the GAO, we were looking at some of that, and they do run something called a Pinkerton Report to see if somebody was ever arrested. And sometimes What hurts the person more than anything is they don't tell them about that they faced arrest, because they think there's no way they'll know about it because there wasn't a conviction. Meanwhile, they found out you're arrested and now they know you lied about it. Okay, I don't mean you, but the person. Okay, requiring supervisors to prepare performance evaluations, training. Okay, periodic rotation of personnel, not only so that the personnel get a chance to work with different supervisors and be evaluated by different individuals in the firm, but also remember we need to make sure that we don't assign the same staff to the same engagement year after year after year, because then they start to lose, probably subconsciously, lose some of their objectivity as it relates to that client. So you definitely want to rotate your staff from year to year. Try to keep some of the same staff from year to year, but you also want some rotation. And then consider opportunities for on-the-job training. Okay, so flashcard, and again, the approach here is we're going to flashcard activities that will accomplish the objective under each of the elements of the quality control system, okay, or quality control standards. Now, engagement, client acceptance, and continuance. Now, this is probably an underrated area of quality control, because people forget that the reason CPA firms get in trouble is generally not because they themselves were initiating some sort of activity, but they got involved with the client. The client was doing some things that weren't so great, and then that pulled down the CPA firm as well. And the classic example is what happened with Enron, and then what was a big 8 firm at the time when they had 8, Arthur Andersen. And so it's a big deal. Not only, what clients you accept, but what clients you continue with. A client that may be very good for you today may be a problem for you, 2-3 years down the line. So it's not only acceptance, but it's also continuance. Now, because the implications that this can have and how it can hurt the entire firm, we are really going to see that there's procedures here. The objective here is to minimize the likelihood that the firm will accept a client whose management lacks integrity. Okay, so you take a look, and the firm must be able to perform the engagement within reporting deadlines. So that one's kind of a harder one, because what happens, this is our livelihood, right? And you look, and you may see a client that maybe is going to have some nice audit fees and potential for consulting in that, and you do what? You bite off more than you can chew. And look, the standards have no sympathy for you getting halfway through an engagement and not being able to complete it in a timely manner, not be able to complete it successfully. Think about it. It's sort of like, you get on a plane, the pilot takes off, and you're flying along, and then the pilot says, by the way, I'm not real comfortable in landing the plane. Okay, we can't have that. And so the standards have no sympathy for a CPA firm that takes on a client that they don't have the ability to successfully complete the engagement within the relevant time frames. Okay. Also, we need to make sure that we are independent. Okay, so we have to make sure that we're avoiding potential for conflict of interest. Now, again, these are the objectives of the acceptance in part of the client acceptance continuance part of the quality control standard. So what would be some activities? And again, our approach is going to be to flashcard the activities under this. So reviewing the financial statements and credit rating a proposed client, right? What happens? Client doesn't have so great of a credit rating, potential that they may want to engage in some sort of financial reporting fraud to make their financial situation look a little better. Requiring of third parties as to reputation of proposed client. That's why it's not a bad idea to be involved with some association. For example, you have the American Institute of Certified Public Accountants has different groups. There's an organization called that I used to be involved with, the Association of Latino Professionals for America. It used to be Finance and Accounting, the F and the A. They changed it to For America, but it's primarily a finance accounting group. There's a group called Ascent, NABA, National Association of Black accountants. All of these groups are good groups to potentially become involved with, so that when you're starting your practice, it's not a bad place to maybe learn about some new potential clients. Sometimes when you're involved in a group like that, maybe I don't have the bandwidth to take on a client, and I say, well, talk to my associate who's involved in this organization. I think he's got a little, or she's got a little extra time that might be able to take that. By the same token, I may tell you, hey, don't take that client because they're in trouble, right? Okay, so that's how you could do that. Evaluate the firm's ability to properly service the client. Do I have the technical knowledge? Do I have the staffing levels to be able to complete this audit successfully? And then periodically reevaluate clients for continuance. Again, just because a client was good for acceptance a couple of years ago doesn't mean that they're still good for continuance today. And so you would probably do this kind of thing annually. Again, you can kind of see we have the objectives. Best thing is to flashcard the activities that'll help achieve those objectives. Okay, good. Taking a look at leadership. Okay, responsibility for the quality within the firm. And look, this is going to be individuals at a high level. Okay, this is a partner level type of thing. Okay, so just remember that about this. That says partner level. And guys, my writing, as you know, was always bad, and it's worse because I cracked my screen and I got it replaced, and the new screen sucks. So anyway, partner level. I'll do my best to try to roll with it, but it's not the best screen. Okay, so partner level. This leadership is the top of the firm. You don't come in and have somebody, just come in the first day and say, hey, guess what? You're in charge of the quality control system. That's something that's done at a high level. Okay, now performance policies and procedures should be established to achieve consistently high performance. And probably the most important word in that little sentence there is consistency. Okay, we want our audits to be performed at a consistently high level. Okay, so let's take a look at some of the activities then that we will engage in to ensure that our audits are conducted at a consistently high level. By the way, I probably should have pointed this out at the very beginning. Notice we talked about the audit reports, and that was at the end of the engagement. We talked about that first. Now we're coming back, and notice we're at the very, very beginning of the engagement. In fact, we're even before the engagement at this point, and that we're talking about how to set up our firm before we even start taking in clients, right? Okay, just again to kind of keep in mind how we're going to be going through and building as we go through the different steps of the audit. Okay, so examples: to consistently meet standards, we're going to design individuals with expertise in certain areas, SEC, government, whatever, and we're going to SEC reporting requirements if we're doing government audits, right? And go say, hey, go see so-and-so. And that there's always somebody in the firm that's like a machine. They press a button in their head and they say, well, what you need to do is you need to go to standard 3379, and that's will give you everything you need to know. Or they'll tell you, well, you can try this, you can try that, and bring it back to me, and I'll take a look at your plan and see if you're, there's always somebody like that in the firm. And so you would designate those individuals with expertise. Okay, referring questions to appropriate group within the AICPA or state society. And I kind of roll my eyes when I see that, because you always think, oh boy, that means the AICPA is standing ready to answer my questions. Good luck, okay, getting answers from these guys sometimes. But they do write the exam, so we better go ahead and flashcard that, because that might be the answer to a question. Developing and using standard audit forms, checklists. Again, remember, we're trying to accomplish consistency. So we have standardization in how we document certain things. That's a good way, in how we perform certain procedures. That's a good way to ensure consistency. Establishing procedures for reviewing engagements. Okay, we'll say, hey, there has to be a second partner review. In my office at GAO, we had a process called referencing. And so after I would write my report, I have to index every single word, fact, number, statement, conclusion, everything in that report has to be indexed. And then a GAO auditor who has nothing to do with that assignment comes back and checks every single fact, figure, number in there. It was one of the few quality control steps that we had that I strongly believed in, because when you have sort of a colleague saying, John, I don't know that you supported that particular thing, you're either going to make sure that you get the appropriate evidence to support that, or you may have to change what you're saying about a particular fact matter. It's a very good quality control step, and that's the kind of thing you'd want to do to make sure you have consistency in your engagements. And of course, we want to restrict access to engagement documentation. Okay. Now we have this quality control system that we put in place, but we just don't put it in place and say, there, it works, and assume it works. We have to monitor it to see that it is indeed achieving the objectives of the quality control system. So in other words, is it operating effectively? Okay. Now, the key thing down here is you make sure that that monitoring is being done at a high level. A partner, okay, someone at a high level is the one that's going to be monitoring that quality control system and ensuring that it's working the way it's supposed to. Okay, now let's look at some of the monitoring procedures. Okay, and they tell us that peer review is a key part of the monitoring process. And we're going to talk about peer review here in a couple seconds. But peer review is where one CPA firm comes in and looks at another CPA firm. And when they look at them, they're looking at the quality control system. Sometimes people think when you have a peer review, oh, it's all about that they're going to look at my audit work papers and see if I followed everything. Well, that's sort of the end step. The key step, the process step, is looking at the quality control system to see if we have the human resource, the engagement, acceptance, right? The leadership, all of these different processes, the monitoring, et cetera. So that's really more of what the other CPA firm is doing. And they call them peer review because it's firms of similar size. So if it's a multinational firm, like one of the big four, it's probably another one of the big four. If it's a local firm, it's another local firm. At the GAO, we had other countries and auditor generals look at us. So I think we had the Canadians for a while, we had the Dutch for a while, that kind of thing. Okay. Okay, good. Now you come over, and another quality control step, and let's just flashcard these couple down here, okay? Another quality control procedure is something called second partner pre-issuance review, and Sarbanes-Oxley. So that means if we see Sarbanes-Oxley, guys, and I may not always remember to tell you, that means what? That means public company audits, right? Okay, so under Sarbanes-Oxley, okay, for public companies, okay, there has to be a second partner pre-issuance review on every engagement. That means that before the report can be issued, a second partner has to look at that before it actually gets released. And that was something that came under the Sarbanes-Oxley Act, and therefore pertains to public companies. Okay. Okay, good. Now we mentioned peer review, and let's take a look for a second at peer review. Okay, and as I mentioned, peer review is when another CPA firm looks at a CPA firm and they're looking to see that the quality control system is following the proper peer reviews. I mean, not peer review, but quality control standards that we've been talking about. So the CPA firm that is a member of the AICPA must have a peer review done every 3 years in order to maintain membership in the AICPA. Now you look at that and you say, oh boy, so if I don't want to have a peer review, I just won't become a member of the AICPA. Perfect. Well, it's not that easy, because what happens is the state accountancy acts. I know it's the case in California, and it's often the case in other states, I'm sure. They will say, hey, you want to be a registered firm in our state? You have to have a peer review in order to be a registered firm in our state. And even though we say here that the CPA firm can choose the entity, the other CPA firm that peer reviews them, um, generally what the Board of accountancy laws will say is that it has to be a firm that is registered with a accepted peer review program. And guess who has the accepted peer review program in the state of California? The AICPA. So the AICPA ends up being the entity that says, yes, this CPA firm is acceptable for peer review, okay, in the state of California and probably the other states. And so when you do the peer review, you'll follow the peer review standards established by the AICPA. So even though you can pick the firm, they have to be registered, okay? And then upon completion of the peer review, they will issue a report and they may say, hey, pass, or you could have a pass with findings or no pass, which you don't want that, okay? But there are different grades that you can get in the peer review, and if they give you corrective actions, you have to take those corrective actions, whatever it is, okay? All right, good. So flashcard these steps here under peer review. Okay, and then ethical requirements, of course, big ethical requirement is what? Independence. Okay, so we want to have our independence requirements communicated to our staff, obviously. Okay, we need to identify threats to our independence. For example, what if we have multiple offices? Well, it gets a little harder to coordinate the independence when you have an office over here, an office over here. You would perceive that as a threat to your independence, and then you would have to address that. Okay, they say at least annually, all staff need to confirm their independence, and that can be done through a formal annual independence confirmation process. But it says at least annually. And when I worked at the GAO, we had to do it every pay period. Every pay period, we signed our time card essentially, but then we would also say our time report, but then we would also say we are free, there's a statement down there, we are free any parents to our independence, so that if something had occurred, you would have brought it to the attention immediately on that engagement. One thing that you probably want to be careful with the independence, I had this happen a couple times. I was coming up with some good findings on a couple of my engagements. And then all of a sudden, the people that we were auditing said, gee, you might be a good person for us to bring on board. Okay, you need to immediately report that kind of thing up. And, that's always the trick. If you're coming up with too many things, a good way to get rid of you is by starting to talk to you about coming to work for them. Now you violated your independence. You may not get the job and the new job, and you will be, removed from the engagement. So don't fall for that one. If somebody starts talking about that, unless you're really, truly interested in working for that company, in which case you still would want to report immediately what's going on so you can be removed from that engagement. Otherwise, cut off that conversation immediately and report it up because we can't have any violation of the independence. Okay, and again, rotation of personnel, which we had mentioned earlier. Okay, good. So let's take a look at examples of some things that we can do, and we'll flashcard those. Again, taking the approach of flashcarding the activity to achieve those objectives, maintaining records, showing which of our employees maybe formerly work for clients, notifying personnel as to the names of audit clients held publicly, so that if you do hold some stock, you can immediately talk to the staffing manager, say, hey, I can't be assigned to that assignment, confirming with staff that prohibited relationships do not exist, and emphasizing independence. Okay, all right, so we're taking the approach here, guys, of flashcarding the activities. I think that's going to be the best bet. Okay, now one thing before we that I wanted to mention before we leave this area of peer review. There is a flashcard for Chapter 2 here, and it seems like some real, you're like, really? And the answer is yes. I have had a dream that the CPA exam loves to ask this. And I had some students told me this same stupid question. My dream students told me this, that this same stupid question kept coming up over and over again. Okay, so what happens? If you audit public companies more than 100, then you have to have a peer review annually. I should say not a peer review, but an inspection by the Public Company Accounting Oversight Board. And if it's less than 100, that has to happen every 3 years. Okay, so that's a flashcard because I had a dream that for some reason the CPA exam thought they should ask candidates something that, I mean, you can look that up, right? I don't know why they got to ask you that and have you pull it out of memory, but whatever. There it is. So you've got a flashcard on it. Okay. Okay, good. Any question on any of this so far? Okay, good. And then as we said at the beginning, as I put us back into full screen, the quality control standards really talk about what? Talk about the structure of the entire firm, right? Whereas our GAS standards talk about how we should conduct each individual engagement, okay? So flashcard that comparison. All right, good. Let's go ahead then with all that, and let's take a look at our couple of first multiple choice questions for tonight. Oops, I don't want that. I want the poll. Okay, guys, go ahead and make your selection. And let's take a look at this one. And okay, good 80% of us got it correct. Now, the answer is C, but the way to answer this question, since they are asking me about the elements, okay, answer is C, but since they're asking me about the elements of the quality control system, okay, then we know that we're using the mnemonic what? Help me. help me is the way you remember the elements of the system. And then you say, well, do any of these things fit under the elements of help me, the mnemonic help me, and what? Assigning personnel to the engagement fits under the human resources part of the mnemonic. So I think most of you made that connection, but remember the first flashcard I gave you there was to flashcard using the mnemonic help me what the elements are of the quality control system. That would help you with a question like that. Okay, good. Now you look at some of these other things and you say, well, wouldn't we do these things on an audit? And the answer is yes, but it's more what? It's more talking about specific things that you would be doing in the audit itself, as opposed to how you would structure your firm's quality control system. Okay, good. Let's go ahead and let's take a look at this next question. Be careful, guys. Don't just read that first choice and think you've got the right answer. You need to read through every single one of the choices carefully. If you read through and you want to bet your firstborn that A is the right answer just after reading A, you're making a disastrous mistake for yourself on the, well, I don't know about disastrous, but you're going to mess up a lot of questions that way. Okay, guys, go ahead and wrap up your selection here. I'm going to go ahead and end the poll. All right, and we take a look at this one. And okay, good chunk of us got it correct. The answer is C. Okay, now the thing about this question and why I was cautioning not to pick the first choice there is you look and it says, which of the following is not true? Okay, if you miss that not, then you're going to read and you're going to select that first one because what? 3 of the statements are true, 1 is false. And if you blow past that not, you don't notice it, okay, then the first statement you read will be true and you'll think that that's the right answer. So you always have to read through all the choices, regardless of whether you think, oh, A's got to be correct, so that you will read the first one. Quality control standards relate to the conduct of a firm's entire practice, whereas professional standards such as GAS relate to the conduct of an individual engagement. We flashcarded that. That's true. The question's asking us which of the following is false, what is not true. Okay, so then you go to B, and the adoption of quality control standards increase the likelihood of compliance with professional standards. Absolutely, that's true. That's why we're following the quality control standards. That's why the ICPA established them, okay? Now you look at D, a firm that has adopted an appropriate system of quality control may still be in compliance with professional standards, a firm that has not adopted may still be in compliance with professional standards with respect to individual engagements. Okay, just like people that drive too fast may not have an accident, but you're certainly asking for trouble, right? If you start to drive too fast. So yeah, that's true, but you're asking for trouble. C, a firm's failure to establish or comply with an appropriate system of quality control implies that the firm has also failed to follow professional standards, not necessarily, although again, you're taking a risk. Okay, so it does not necessarily mean that it doesn't also mean that you fail to follow professional standards, but you've increased the likelihood that you will not, but it doesn't automatically mean that you will not follow the professional standards. So you look at a question like that and you think it's simple, and then you kind of see, well, wait a minute, I had to read this carefully and think through this pretty carefully. So read through all the choices. If it's looking for something that's not true, get yourself comfortable with what is true, right? And then that not true one, even though they kind of wrote it up in a squirrely manner, weasel worded it on us, you should be able to, kind of eliminate the others and pick that one. Okay, question? Okay, good. Let's come over and let's start to talk about documentation. Okay, now, when we look at documentation, I'm going to jump down to the reason or the most important thing to think about with documentation. Okay, and it has to be prepared in enough detail so that an experienced auditor who has no previous connection with the audit can understand what was done on the engagement. Okay, and I'm not going to get into the detail what they want to understand because I think it's self-evident as you start to know what you're doing on an audit. But this is something to keep in mind when you're thinking about documentation, right? Because you're not going to necessarily be there at the time that pre-issuance review is done, or at the time that there's a supervisory review. Heck, you may already start to be assigned to another assignment in another city, and then all of a sudden you did some work there and someone's looking and saying, what is this? And you don't want them to always have to come back to you to say, what did you do here, right? So it has to be enough detail so that somebody can basically do the appropriate supervisory review, second partner review, whatever it is that has to be done, right? Now, go ahead though, and let's look at this one. There has to be something that shows that the accounting records, that the audit papers, work papers, etc., relate to the financial statements. Remember, reconcile the financial statements. Remember, we're auditing financial statements. And so the classic way that this is done is there's a lead schedule. And what the lead schedule does is it has the financial statements as one piece, and then there's an index back to the section of the work papers where the different parts of the financial statements, where's the audit evidence to support those various aspects. Okay, so lead schedule is the best way to show that the accounting records reconcile with the financial statements. And again, it's going to allow us to conduct the appropriate supervisory review, quality control review. All of those things are done when we have the proper audit documentation. Okay, all right, good. Now you come over and let's just take a look at retention. And how long do we have to complete all of our work papers? Because we may issue the report, but we still need a little time to clean up our work papers, okay? So documentation is pretty easy, okay? Documentation, all of this, document retention, I should say, and completion date, they're very easy, but flashcard them, okay? So we have to retain our work papers in support of our audit for non-public companies, 5 years, public companies, 7 years, okay? The completion date is how long from the date the report is issued do I have to basically clean up my work papers, okay? Once you go past the audit completion date, you can still make changes to your work papers, but you'll have to leave whatever the original was. But within this, and for public companies, it's a 60-day window. For non-public, it's 45. You can erase, take things out, whatever you need to as you complete your audit documentation. They give you that window of time. After that, you can still make changes, but you'll have to leave the original and then explain why you had to make a change. Okay, so 60 days for, did I get it backwards? Did I say it backwards? I did. It's funny because it's the other way around for the, oh, right. It's more conservative to give you more time. Okay, yeah. So AICPA for non-public companies, I'm trying to think, it has the more liberal. Yeah, they give you 60 days to complete everything. The longer the period, the more liberal. So I did say it backwards just because I have the logic in my mind got in the way there. In that 60 days is more liberal. They give you more time to complete the documentation for non-public companies, 60 days, 45 days for public companies. So flashcard that. Any question on that? I kind of got that reversed in my head when I said it. Okay. Okay, good. Come over and let's take a look at content, specific contents. And the permanent file is things that are of a long-term nature. Okay, they go from audit to audit, from year to year. For example, the company doesn't, come up with new bylaws every year, new articles of incorporation. Okay, longer term things like information about leases, stock options, all of these things are longer term. So you're going to put those in the permanent file, and that will go forward from year to year as long as you have an involvement with that client. So, you don't want to keep going back to your client every year and saying, can we have the articles of incorporation? Well, we gave it to you last year. Okay, here it is again. You come back the next year. Can we have the articles of incorporation? What's wrong with you? We gave it to you last year. So you put those kind of things into the permanent file, okay? Current file relates to what? Applicable to the current year under audit, such as the current year's audit program, financial statements related to the current year, audit report, and so on, okay? I'm not asking you to flashcard this stuff, guys. I think it's pretty, easy to remember. Permanent file things are of a longer term nature. Current file things tend to relate to the current year under audit. Okay. All right. And then tick marks, and I find this annoying. Okay. That the AICPA thinks that there is a standard tick mark legend that is used by all CPA firms, and nothing could be further from the truth. So they should never give you a question that asks you to, interpret a set of tick marks, okay? But if they do, particularly now that they have those document review simulations, give yourself some kind of fighting chance if you get a stupid question like that by making this flashcard. I mean, if I put something like this in my work papers when I was a GAO, they'd say we caught the Zodiac killer. Okay, so that means nothing in the GAO where I worked. Yet for some CPA firms, maybe that does mean agreed to voucher register. Other firms, maybe it means we took a coffee break at that time. I don't know, but just flashcard those just in case. Okay. Okay, good. Let's take a look at this question about audit documentation. If you guys don't know who the Zodiac killer is, when I was a kid in the late 60s, there was someone going around killing people, and then he'd leave notes that had, all these kind of little tick marks, and that meant, they interpreted those, and that meant something when they looked at it. That's why I look at some of those tick marks. I'm like, who? I didn't know the Zodiac became a CPA.
Thought it was just a movie.
No, it was really scary. No, they made a movie out of it, but I remember it was in the Bay Area and he was going around killing younger people. Um, so it was pretty scary, yeah. And then he just disappeared. He or she, I assume it was a he.
So he was never caught at all.
Nope. Some people figure he just died or killed himself or something, but he never got caught. Then some people say, well, there's this cosmic Jack the Ripper that keeps moving through generation after generation, and that was him. I've heard that theory too, but I don't believe that one. Okay, go ahead and take your best shot. Let's go ahead and look at this one. Yeah, and we got a good response. And you notice I had you flashcard that. So most of us, let me share the results here, got this one right. And I had you flashcard something specifically there. Now, when I look at these, they're kind of cute when you look at them in concert together. C is the right answer. Not be permitted to serve as a reference for the client. Hey, if you've got some analysis that you've done that you think would be helpful for the client to maybe do that annually each year or periodically, why not? Then your client's going to sit there and they're going to be doing some things maybe that you're having to do at the year end. They could be doing it throughout the year and provide that information to you, and it's going to make your job easier. So there's nothing wrong with that. And then I like, it's kind of cute. You take these two together, serve as a reference source for the client, and then you give them stuff that has critical comments about management. That probably wouldn't be the best thing, but you can still, in the part that you don't share with the client, include critical comments about management, because you want to make sure that's communicated to the next audit team. Management is aggressive in their projection of earnings, and that could have a particular problem. Could be evidence of an indicator of fraud over the revenue or something. Absolutely, you want to put that kind of thing in there. Okay, we know that the right answer is, so there could be critical comments about management. Showing that the accounting records agree or reconcile with the financial statements. Yes, okay, that one didn't have the word not in front of it, so yeah, we can do that. Be considered the primary support for the financial statements being audited. Okay, good. What happens? The work papers, your audit documentation supports your opinion. The evidence that you obtain from management and from outside the entity, whatever, the evidence that you acquire, that supports the financial statements. Okay, so your work papers support your report. The evidence that you get and you include in your work papers support the financial statements. Okay. Okay, good. Let's take a look at terms of engagement. Okay, and let's take a look at something that's required of Sarbanes-Oxley. And again, if we say Sarbanes-Oxley, that is synonymous with saying what kind of companies? Public companies. Okay, so Sarbanes-Oxley said, look, we are going to require that public companies have an audit committee, and that audit committee needs to oversee the auditors. So they basically hire and fire the auditors. Now, the audit committee is part of the board of directors, but we use a more general term here, those charged with governance. Okay, but it is required that if you're auditing a public company, okay, that they have a board of directors. The board of directors contains various committees. There's an audit committee, and that audit committee is responsible for overseeing the conduct of the audit, okay? And sometimes we call them those charged with governance, because not every organization has a board of directors. For example, if you're looking at a public housing agency, then public housing agencies will have what they call board of commissioners. Okay, so to not just limit it to the term board of directors, those charged with governance is somebody at the top of the organization, and those charged with governance have to have those that are responsible for the audit. Now, sometimes a board of directors will be very small. There'll be maybe 3 people on the board of directors. Well, then the entire board of directors is going to have to form the audit committee. Okay, so, but if you have a board of directors that's large enough that you can peel off 2 or 3 individuals to be the audit committee, then you would do that. Okay, okay, good. Timing. You probably want to appoint the auditor before the year starts, but it is okay to appoint the auditor after the start of the year, okay? Or even, after the start of the year or after the end of the year, okay? You may have to do that. And if that's the case, then you may have to make special considerations in how you're going to conduct that audit. And the good example that we had was, remember we said, hey, what if you're hired after the start of the year? How does that impact your ability to observe them having taken the beginning inventory, right? Remember we said, hey, may result in a qualifier or disclaimer of opinion, or you may ask the client to retake the inventory in the new year and then back through the records to figure out what the beginning inventory was. All of those would be the nature of special considerations that you would make if you were engaged after the year had started or even after the year had ended. Okay. Now, when you look at the client acceptance, okay, and there's these different things that we need to look at, okay, and the first thing is, can I properly complete the audit? Again, we saw that in the quality control standards. The auditing standards have no sympathy. The state boards of accountancy have no sympathy. And if you ever pick up something called the, I forgot what they call that stupid thing, CPA letter, I believe it's called. It's something that's published by the California State Board of Accountancy. You can go to their website. It's a quarterly report. It might be just, they might just call it their quarterly report. I forget what they call it now. But always in the back, California Board of Accountancy, I'm sure other boards of accountancy do this, in the back of that quarterly report, they list disciplinary actions, okay? And you'd be surprised how frequently you see they accepted a client when they did not have the expertise or the staffing levels to successfully complete the audit. And the person is getting some sort of disciplinary action, suspension or censure on their license or something, a limitation on their license of some sort, because they weren't careful in accepting the client because they did anything wrong, not because the client did something wrong. Well, the thing they did wrong is they accepted a client. They took off in the airplane and then couldn't land it. Standards, regulators have no sympathy for that situation at all, okay? Come over. So you need to look at the firm's ability to staff the engagement. So not only do you have to have the expertise, you have to have the appropriate personnel. Of course, you have to be independent, and then you want to minimize the likelihood that you will be involved in a client whose management lacks integrity. And you can put down here, number 1 reason not to accept a client. Okay, and you may even want to flashcard that. Okay, because if you see a question, they say, which of the following would be a reason not to accept a client? And you look at the list and you see management lacks integrity, that's the right answer. Okay, so that would be the number 1 reason not to accept a client. Now, I know independence feels like it should be the number 1 reason. The CPA exam never asks that. And the CPA says, you're not independent. Should you accept the client? Because everybody knows the answer to that is no, you shouldn't. This idea of the management lacks integrity, that one may not be as obvious to you. So make sure you're, considering that when you're looking at choices as reasons not to accept a client. Okay. All right. Preconditions for an audit. And let's just go over to management imposed scope limitation. Okay, and let's just flashcard this. So what happens? Management imposes a scope limitation on you that you know going in before you even accept that engagement, that limitation is going to result in a disclaimer of opinion. You can't accept the client. So you can't accept a client going in knowing that they have imposed, management imposed, not circumstance imposed, management imposed scope limitation can result in a disclaimer. You can't accept the engagement. Okay. Now you come over and there is an exception to that. And the exception is, hey, if the audit is required by regulation or law. For example, the legislation, CFO legislation, says that my old office, the GAO, is going to be the auditor record of consolidated financial statements. So the GAO can't not take that engagement because the law says. State of California, I believe it's the state controller's office. Forgive me if I'm wrong, but I'm pretty sure it's the state controller's office that legislation says will audit the financial statements of the state of California. Well, they can't not take the engagement, okay? But generally speaking, unless it's an audit required by law or regulation, if there's a management imposed scope limitation that will automatically result in a disclaimer, then you cannot accept that engagement, okay? Now you come over, and if it's a scope limitation that is going to result in a qualification, that's okay. You can accept that engagement, okay? So it's only when it's going to result in disclaimer that you would not be able to accept that engagement. Whereas if it's going to result in a qualification, the management imposed scope limitation, then you can still accept that engagement, okay? All right, good. Let's talk about engagement letter, okay? And it is required. Engagement letter is required on all engagements. So when we later on start looking at other types of engagements like preparation, compilation, review, audit, is really what we're talking about here, you must have an engagement letter required on all engagements, okay? So let's just go ahead and let's take a look at the reason for the engagement letter. It is so that neither party misinterprets the responsibilities of the other. Okay, so we've got to have an engagement letter. Let's go ahead and let's, at a high level, on the next page, start to take a look at the required contents. Now, this is at a very high level, okay? So the engagement letter, which you must have, has to talk about the objective of the audit, the responsibility of the auditor, the responsibility of management, and a discussion about inherent limitations, okay? High level flashcard that every engagement letter has to call out those things, okay? Now you come over and they start to talk about other contents. And when they talk about other contents, for example, fees and billing arrangements. Now, here's the trouble, guys. The way Becker kind of read this information, it almost becomes impossible for me to give you a good way to remember some of the checklist of things that might go into an engagement letter. So I finally gave up on trying to make sense of that mess that they have there on the outline down there where they start listing all this detail. Okay, and this is a good flashcard because it's high level, but this becomes a little messy, you know, and I'm just calling out fees and billing arrangements there for fun, because what I really have here is this one, okay, this flashcard right here. And this is my weak attempt at a mnemonic. I'm not good at mnemonics, okay? So this is a crisp porta, okay? If you've ever had some wine, right? It's just picture a guy going, ooh, that's a very crisp porta, okay? Whatever. Or just memorize these things from the flashcard, okay? So notice we had what? Management's responsibility, auditor responsibility was high level, but you can see some of the things that fall under that. Responsibility of management, internal control, providing a representation letter. Remember we said last time, representation letter comes at the end of the engagement, rep letter. It's when they tell you all these different things that they told you about, all the important things. They get the rep letter. And then the engagement letter, which is what we're talking about here, comes what? Engagement letter comes at the beginning. Okay, so we put in the engagement letter at the beginning of the engagement, we point to a letter that we're going to get from management at the end of the engagement. Why? Well, we have to receive the management rep letter at the end of the engagement. If they don't give you the management rep letter at the end of the engagement, you're going to have to qualify your opinion and the last, or withdraw. And the last thing you want to get into is a fight at the end of the engagement after you spend all the resources that they don't want to sign the engagement letter. So, the rep letter. So what do? In the engagement letter, you say you're going to give me this letter at the end of the audit. And then if they start messing around and refuse and they don't want to sign her, they don't understand what it is. I had a client one time where she said, I'm not signing that. That says that I'm responsible for, I'm not signing that. And I had to kind of talk her off the ceiling of what it meant and whatnot. But if you had a client that held firm and said they're not signing it, then you could show them the engagement letter and say, well, wait a minute, you've already agreed. The engagement letter is a contract. You've already signed and agreed that you're going to give me this management rep letter at the end of the engagement. Okay. And so you can look at some of these other things. Okay. Remember we were talking about the idea of subsequent events, that's mentioned in the rep letter, right? But also you're letting them know now, hey, subsequent events, we're going to keep on you on things that happen after the date of the financial statements, before we issue the report, etc. Okay, so you've got this flashcard that helps with the engagement letter. And then you've got this one, which is a true or false flashcard. True or false, audit fees and costs should not be discussed in the engagement letter. You know that's false. I just showed you that in the outline. True or false, all audit engagement have to have a written engagement letter. That's true. And we saw what I mentioned that. Okay. Okay, good. Let's come over then with all that and let's go back to the outline. Okay. And what happens if you have a recurring audit? Okay. Well, if you have a recurring audit, okay, it is not necessary to reissue an engagement letter for a recurring audit. Okay. You don't have to. Some people say, whoa, my firm, we have a new engagement letter every time. And yeah, that's probably a wise practice, but the standards are telling us you don't have to issue an engagement letter every time. However, you will probably want to, you will definitely want to look at these situations, see if the terms need to be revised. And even if the terms do not need to be revised, you still, either in a written or oral fashion, should remind management that the terms of the previous engagement letter are still in place. I'll tell you guys, I would issue a new engagement letter every year. And if you don't want to do that, you should definitely put in writing by email or whatever that the previous year's engagement letters terms still apply. Maybe attach a copy of that, document it somewhere. If you have an oral, if you get down to doing an oral discussion, then document the time, date of that oral communication, document that in the work papers. Okay. Okay, good. Now, if you have an initial audit, okay, initial audit meaning that you haven't audited that client previously, or the statements were not audited by a predecessor auditor, you're going to have to go through certain steps. Now, if there was a predecessor auditor, then you have to have communication with the predecessor. Now, what is the predecessor? You audited last year's statements. I audit this year's statements. You're the auditor. You're the predecessor auditor. I would be the successor auditor in that little example. And it is mandatory that the successor make inquiries to the predecessor auditor. Client permission is needed, however. Now go ahead and flashcard that, but that's the kind of thing that used to drive me nuts when I was studying auditing, because if it's mandatory, then how can I have to ask the client? Well, they want you to ask the client, and if the client has a good reason for saying no in terms of your communication with the predecessor, then you could forego that step, but you need to seriously consider the implications for your audit. For example, if they say, well, we are in a lawsuit, we're engaged in a lawsuit with the predecessor, well, then you're going to probably want to understand what's going on. Maybe you can talk to the legal counsel of this potential client and try to understand the nature of what's causing that lawsuit. And if you don't like the sound of it, step away, right? Because you may be the next one that they're going to get into some litigation with because they just aren't doing things right. Maybe the management lacks integrity, right? So you can accept without doing these required communications that need to be made before acceptance. But if you don't do it, it has, it's weird. So, be very careful about that. Okay. Now, what are the required communications? Okay. These need to be made when you are going to accept the client. And notice that all of them really come down to, hey, do we have a management that lacks integrity? Okay. Issues that might bear on integrity, disagreements, predecessor's understanding for the reason for the change. Maybe they're just opinion shopping. Maybe they're very difficult. There's something that the auditor walked away because they were concerned about the integrity. Anything about fraud being communicated. Okay. Put down here and continue on this flashcard. Also, ask client to arrange review of predecessors' work papers. Okay, the work papers belong to the auditor, but you're probably going to want to review the predecessor's work papers, but you don't just call the predecessor up and say, hey, let me look at them work papers. I'm going to be over there tomorrow, Joe. You first have to ask the client to ask the predecessor to let you look at their work papers. And then when you go and you look at the predecessor's work papers, you're probably going to go to their office. They're going to lock you up in the conference room. When I say lock you up, I mean, they lock the door, but they'll put you in the glass conference room. You'll have all the papers there, and then they're going to basically assign somebody to watch you the whole time while you look at those, while you review those work papers. Okay, but it is a step that you'll want to do, and you'll ask the client to arrange that. Okay, now what happens if you do all the process here, you accept the engagement, you get the engagement letter done, and then you get through the audit and management says, oh, we don't want an audit anymore. We'd like you to just do a review, or we'd like you to just do a compilation. Well, before agreeing to that, you have to make certain considerations. For example, what is the effort required to complete the engagement? Look, if you are pretty much done with the audit and then they turn around and say, we want a review, you're going to say, no, we're just going to issue the audit report because we have the evidence, the work done to issue the audit report. Because it would be a little weird for them to all of a sudden start asking for a report that gives less assurance than the report that all you got to do is press a button now to issue it. Okay, so you want to consider that. So there would be, though, acceptable reasons, okay? For example, if you haven't almost completed the audit, maybe you're in the early stages of the audit and the requirements change. Hey, guess what? The bank says we just need a review, not an audit. Okay, that might be an acceptable reason. Or maybe they misunderstood the scope of the service and you start doing some things like asking them a lot of internal control questions. They're like, wait a minute. This sounds a little beyond the scope of what we need. They go back to the bank. They said, he's asking us all these questions. The bank says, well, we just really need a review. Oh, okay, well, now we don't have to make as many inquiry about the internal control if it's review versus an audit. So those would be acceptable reasons. Let's flashcard the unacceptable reasons. And again, you're about ready to issue the report and you've uncovered some sort of fraud, and they say, don't issue the audit report, just give a review. No, okay, or the client is trying to mislead or something and they don't want to see you get as much detail or as much evidence because now you're going to find errors, fraud, etc. So they tell you, oh, stop auditing, just give us a review. No, that would not be an acceptable reason. Okay. Okay, good. Let's go ahead and let's take a look at a couple multiple choice questions here.
I have a question.
Huh?
So have you ever heard of a predecessor not giving the working papers?
Have I ever heard of it? I've never been involved in a situation like that. I'm sure it's happened though, right? Because a lot of times predecessors are upset because they lost the client, right? So they try to give you a hard time about the work papers and seeing them. But I would say it's sort of professional practice to let the successor look at the work papers. So I think it would be unusual, but I don't want to say it's never happened.
But they're not legally obligated to give the working papers, are they?
Um, I'm not sure if there's something that would be governed at the state level. And I'm not sure if there's something in the accountancy acts at the state level that would require them to do that. It's not a gas standard. It's not like something in gas says, gas talks about the conduct of the audit. It may be in the AICPA's Code of Professional Conduct, and so therefore it may be in legislation at the state level. I'm not sure, but it would be highly unusual for them not to.
Okay.
Okay. Okay, good. Let's go ahead and let's take a look. And okay, half of us got this one right. Okay. Which and a successor auditor should request the new client to authorize the predecessor to show the work papers. Yes. The engagement letter, no. I mean, that's so C is the correct answer. That could be problematic because it's really a contract between the predecessor and the client. And so you're probably overstepping unless there's something specific in the legislation as to how that audit's to be done, because sometimes you do have that. If you're auditing, say, a government entity or something, then there will be a requirement that they share the engagement letter with you. But typically, it's not something you should do because it really is a contract between the predecessor and the client, and really not something that the successor should be privy to. Okay. Okay, good. Let's go ahead and let's take a look at the next question. So C was the right answer on question 1.
Yeah, I super overthought that question.
That's all right.
Yeah, I was reading it like it was my engagement. Well, the auditor's engagement letter, not the predecessor.
You mean the number one, question one?
Yes. Yes.
It happens. Remember, when you first see these questions, you're kind of, it's like the first time you did an exercise or something, you're like, oh my gosh, this is the hardest exercise ever, right? Then you kind of do it a second time, a third time. By the time you're walking into the exam, you're very in condition to deal with some of the weird way they word some of these questions and stuff.
That's why I'm trying to get prepared to stop doing that, like just gunning in and hurry up and trying to answer.
Yeah, at this point, I'm not as interested in speed as I am accuracy. So at the beginning, we're just trying to get the concepts down. We're trying to accurately, get the right answer, try to get it 75% of the time, the first time we go through these. As you go through the final prep process and the weeks leading up to your exam, that's when I start talking about building time. And then finally, by the time you're taking your practice exam, you got 4 hours to complete all of the testlets, the 2 multiple choice testlets and the 3 task-based simulation testlets, and you're getting a good sense as to how your timing is going on the exam. Generally speaking, my students do not have trouble with time on the audit exam. Okay, time becomes more of a crunch for you. Financial FAR is probably the biggest one where time is, a problem. Then maybe regulation, then maybe BEC, they may be tied for second there. And then audit tends to be the one that students don't have a time consideration, but you got to be careful because the wording on these questions get funky. And so you've got to read carefully and make sure you're giving yourself the appropriate time to do that. Okay, good. Let's go ahead and let's take a look at this poll, this question. Oops. Okay, and yeah, well, 60% of us got it right. Okay, and I'm a little concerned there. I'm not sure why that wasn't in the high 90s, but let's go ahead and let's look at this one. Okay, and the answer is A. Okay, which of the following matters generally included in an auditor's engagement letter and management responsibility? We have a whole section on management's responsibility. So I'm looking at A thinking, okay, that's got a good shot. But let's look at these others. The factors to be considered in setting preliminary judgments about materiality. I mean, where did we say anything of that nature? You will set preliminary judgments about materiality, but we're not putting that in the engagement letter, for crying out loud. I mean, what do we want to bore management with that? That's something that we are going to consider and make a decision about, but we're not going to put it in the contract with management at the beginning of the engagement. So no. Management's vicarious liability for violations of laws and regulations. Any question that has the word vicarious in it is not a good choice. Okay, vicarious liability, meaning that management is responsible if one of their employees commits an illegal act, and that's true. Okay, if the employee is speeding and they hit a vehicle and there's damage done, yeah, the company is responsible for that. Okay, but we're probably never going to really have that conversation with them unless there's actually been an accident and we think there's a continuing liability issue. Engagement letter at the beginning of the engagement, why would we be having that conversation? Auditor's responsibility to search for significant internal control deficiencies. Hardy har har. We are not here to search for internal control deficiencies. We are here to do what? Audit the financial statements. And as part of that audit of the financial statements, we will obtain an understanding of the internal controls sufficient to evaluate the design of the controls, see that the controls have been implemented, and use that to make an assessment of the risk of material misstatement. And then we will structure our audit procedures around that risk assessment. We are not there to search for internal control deficiencies. That's not the nature of the engagement and financial statement audit. And so certainly the engagement letter would not talk about that. Okay, so make sure you're looking at those couple flashcards I gave you that call out the detail of what goes in the engagement letter, but also that high level one that had manager's responsibility, auditor's responsibility, would have led you to get this one correct, that A, management is responsible for the fair presentation of financial statements, and that's something we're going to put in the contract. We want to make sure they realize that going in. Okay, question? All right, guys, let's go ahead. Let's take a quick break here. I'm showing 6:31, so why don't we come back at 6:30? Yeah, we'll just make it 6:40, okay? We give 10 minutes, come back at 6:40, okay? I'm going to pause. Somebody remind me, please, when we come back to start again. Resume the recording, and let's go ahead and continue our now discussion. We've accepted the client, we have the engagement letter, and now we're going to start doing some very early preliminary planning type steps. Okay, so let's just first consider the nature of supervision, right? Because we're going to have to put together the audit team and understand what the responsibilities are going to be of the supervisor. Now, when we look at this, when you think of supervisor, maybe you're thinking about, okay, you're talking about a second year staff supervision, but the way the CPA exam talks about is in terms of the supervision that is provided by the partner. So they're really putting you in the seat of the partner and what sort of supervision would the partner provide, okay? So you are directing the efforts of your assistants, that's everyone below partner, communicating with the audit team about the susceptibility of the financial statements to error or fraud. And you start making the team a bit aware of the consideration of fraud very early on, okay? Information about the responsibilities of the assistants, staying informed about what's going on with the engagement, reviewing the work performed by assistants. And again, when we say assistants, we're not really thinking about first year staff. I mean, they are assistants, but we're really talking about anyone who assists the partner. Okay, so what happens? The nature of the supervision is really going to depend to a large extent on the complexity of the task and the experience of whoever is providing that whoever's doing that work, right? Okay, new staff, you're probably gonna have to supervise them more. Don't give them as complex tasks. As people gain more experience, more complex tasks, maybe they don't need as much supervision as time goes on, okay? If there are disagreements, assistants should be allowed to document their disagreement. And this is about very critical matters related to the audit. You know, don't put in there, I disagree that we took lunch at noon or something, you know, instead of 11:30. It's not that kind of a disagreement. It's critical matters, probably something as you are resigning from the firm that you may want to document any disagreements. Okay. All right. Just going quickly, knowledge about the client's business and industry. Very high level stuff here. Knowledge about the industry. Okay. Knowledge about the client's business. Now, the key thing to remember here, I'm not even asking you to make a flashcard about this, is that you can obtain knowledge of the industry of the client's business after acceptance. We are after acceptance discussion now, and that's a little counterintuitive. You think, well, wait a minute, should you have to have knowledge before you accept it? No. You may be able to get into a new industry, a new type of business that you haven't done audit work in before. The requirement is that you need to be able to get the knowledge you need to successfully complete the audit, but you don't have to have that prior to accepting the client. But you have to be confident that you can get the knowledge you need to be able to successfully complete the audit, but you don't have to possess it before you accept the client. Okay. Good ways to get knowledge of the business is to tour the facility, review the financial history. Okay. Inquire of client personnel, obtain an understanding of the client accounting. Guys, if you're like John, you're just highlighting the headings, that's because this kind of stuff is self-explanatory. Try and understand the client's business. These are the kinds of things you would do. Okay, don't need a lot of detail there. Now, you will develop an overall audit strategy. Okay, now again, we are what? We are at the early stages here. Okay, so developing an audit strategy happens early in the engagement. Okay, factors for that preliminary understanding include preliminary evaluations of materiality, audit risk, and internal control. What's the key word here? Preliminary. We're going to talk about materiality here in a little while, but you do that, you make preliminary evaluations, but these things change throughout the audit as the audit goes on and you get additional information. So again, guys, this is the kind of thing, and we even saw a question there talking about the engagement letter. It's not something you put in the engagement letter, but it is something that's happening, the preliminary stages at the beginning of the audit, getting preliminary evaluation of materiality, audit risk, and internal control. Okay. All right, then you come over and you start to develop the audit plan, and there must be a written audit plan on all engagements. There has to be a written audit plan, audit program on every engagement. Okay, and when we write up that audit plan, okay, it's going to have certain categories to it. Okay, and the procedures will be categorized as either risk assessment procedures or further audit procedures. Now, when you look at these and they talk about them below, these are really steps in an audit. Okay, so this is really important. Okay, this is really important that we understand the steps in an audit, the process that we go through, okay, in these procedures. So risk assessment procedures can really be put as step one, and you can put done always in all audits. You always have to do these risk assessment procedures, okay? And the risk assessment procedures are to obtain an understanding of the entity and its environment, including its internal control, in order to assess the risk of material misstatement and determine the timing, extent, and nature of further audit procedures. And further audit procedures are going to be the next step, right? We have two steps: risk assessment procedures and further audit procedures. This is step one. This is step two. Okay, so you have to do that on every engagement. You must do these things. Okay, risk assessment procedures. Obtain an understanding of the entity and its environment, including its internal control, in order to assess the risk of material misstatement, RMM. You must do that on every engagement, and whatever that assessment is will be used to determine the timing, extent, and nature of your further audit procedures. So you come over to the next page here, and here we go, further audit procedures. So this is what? Step two. Okay, now I'm calling them steps. The standards don't call them steps. They call them risk assessment procedures, and then they call them further audit procedures. And when we look at our further audit procedures, They are constituted of test of controls and substantive procedures. Okay. Now, test of controls, okay, are done sometimes. So sometimes we will test the controls. Sometimes we will test the operating effectiveness of internal controls. Okay. Now notice down here, they tell us what? We will also do substantive procedures. Okay. And you can see that there, substantive procedures. And we do those what? We do those always on all audits. You must do substantive procedures. Okay, so let's take a look. And they tell us that test of controls are used to evaluate the operating effectiveness of the controls, preventing or detecting material misstatement. Okay, test of controls are necessary when the auditor's risk assessment is based to some extent on the operating effectiveness of the internal control, or if substantive procedures alone are not considered to be sufficient. Okay, so we do it sometimes. What? If we believe the controls have the potential to be operating effectiveness. So what we did in step one is we obtained an understanding of the controls sufficient to evaluate the design of the controls and determine that they had been implemented. Based on that, we made an assessment of the risk of material misstatement that determined what we did in step two. And so if we thought the controls had the potential to detect a material misstatement, then yeah, we would test the operating effectiveness. Sometimes we do that. Or if we don't believe that we could do enough substantive testing to support our opinion. That happens in an IT environment. And we're going to cover that at the bottom of the page here in a minute. Heavily IT environment, then yeah, you might have to test the controls because the IT system is going to generate enough documentation to allow you to do a purely substantive approach. Okay, substantive procedures, we always have to do substantive procedures. They detect material misstatement, which is why we're here. We want to see if there's a material misstatement, so we know if we have to qualify our opinion or if it can be corrected. It can be corrected by management, etc. Okay, now our substantive procedures, they tell us, include test of details, and it also includes substantive analytical procedures. Now, if we were to create a rectangle, and that rectangle were to represent our substantive procedures, what would happen? The rectangle would, this rectangle represents my substantive procedures, and I would have a lot of yellow here. That yellow is test of details. I'm trying to make that a pen. Test of details. Example of test of details is confirm accounts receivable. You'll pull a sample of accounts receivable. You'll confirm those accounts receivable. You send those confirmations out to the client's customer, and you have a sample of clients, and you're looking at the detail there. Okay. Now, this green up here is going to be the analytical procedures. I'm just going to put AP. That's not accounts payable. That's analytical procedures. Okay. So analytical procedure might be something that you'll do for an account that isn't as material, or if a substantive details approach is not going to be very useful. For example, let's say I'm auditing a laundromat and I want to audit laundromat washing machine revenue. Well, you know, it's going to be a little hard to sit there and see, you know, how many coins got dropped into a machine. So what I might do is take the water bill that the laundromat has, that the client has, see how much water they used, and see if the amount of water they use seems now ties to the amount of revenue, right? Because how can you have washing machine revenue unless the entity used water, unless they're beating the clothes on rocks or something to clean them? But usually in the modern day, right, we clean clothes by using water, right? So what happens? You would do an analytical procedure to see what the water bill was, and that could help you to support the amount that management's reporting for revenue. So the standards always allow for an analytical procedure if you're dealing with a particular account, whatever, that doesn't really lend itself to a test of details like, say, accounts receivable would. Okay, so when we do our substantive procedures, we always have to do them. We can have a mix of analytical procedures and substantive analytical procedures and substantive test of details to comprise, our substantive procedures. Okay, so again, let's look at this discussion here now. On all audits, always, you must do what? You must obtain an understanding of the entity, including its environment, its internal control, sufficient to evaluate the design of the controls, determine that they've been implemented. You have to do that on every audit so that you can make an assessment of the risk of material misstatement. If you assess the risk of material misstatement at the maximum, in other words, you don't like the controls, then you don't have to test the controls. They don't make you test controls that you've deemed to be ineffective. You can go straight to substantive tests, but you must always do substantive testing. And again, it could be analytical procedure, it could be test of details. Okay. If you have assessed the risk of material misstatement at less than the maximum, meaning you probably like the controls, if that's the case, what? Then you're going to go over, and again, coming back to step 2, you would likely test the operating effectiveness of the controls, and that's then going to determine the timing and nature of your substantive procedures based on the results of the testing of your controls. Now, I'm giving you that and I'm showing it to you in the outline, but I have here these couple flashcards, okay, that are really intended here to put it more into the step. Okay, so step 1, we've already said you always have to do step 1, and step 1 are the risk assessment procedures. It is often also called obtaining an understanding phase, okay, because what are you doing in step 1? I have it here all highlighted for you. You are obtaining an understanding of the internal control and the environment sufficient to evaluate the design, key bolded word, to evaluate the design of the control and determine that they have been implemented. You must do that in every audit. You must evaluate the design of the controls, determine that they have been implemented. Based on that, you then assess the risk of material misstatement, RMM. That has to be done on every audit. Okay, now, if you assess the risk of material misstatement at the maximum, you will follow this red arrow to the next slide. If you assess the risk of material misstatement at less than the maximum, I don't know, medium, low, then you will follow the black arrow to the next slide. And the next slide is step 2. Okay. And when you look at step 2 now, we are dealing with our further audit procedures. And when you do your further audit procedures, this is often called the test of details phase. And in the test of detail phase, if you have what? Followed the red arrow. Remember, red arrow meant that we did what? Did we assess the risk of material misstatement at the maximum? That was the red arrow. You follow it to the next page. Okay, and now we go to the next slide. We're following the red arrow because we assessed the risk of material misstatement at the maximum. We bypass the testing of operating effectiveness and we do what? We go straight to our substantive testing. Your control risk is maximum, skip testing operating effectiveness, and go straight to substantive testing. If we had followed the black arrow meant that what? That we had assess the risk and material misstatement at less than the maximum. I don't know, moderate, low, whatever word you want to use there. Then we follow the black arrow. And when we follow the black arrow, we first test the operating effectiveness of the controls. And then we go and we do the substantive testing. Okay. Now, these two slides are designed to give you the key words that the examiners absolutely expect you to know. Okay. And so I felt that it was worthwhile to supplement the book with this because I don't know that you glean the stepped process and the logic of the whole process from the way they wrote it in the book. Okay. So you want to think about it this way. Step one, always, every engagement. What do we call that? Risk assessment procedures. We also call it obtaining an understanding phase. Okay, what do? We obtain an understanding of the entities, including its internal control, sufficient to evaluate the keywords design of the control, see that the control has been implemented. When we do that, we are able then to assess the risk of material misstatement. If we assess the risk of material misstatement at the maximum, we will bypass the testing of the operating effectiveness and go directly to our substantive testing. And we know from the book, substantive testing can include test of details and analytical procedure. Okay. Now, if we assess the risk of material misstatement at less than the maximum, then yes, we will first have to test, key phrase, operating effectiveness of the controls, and then we will conduct our substantive testing. Question. You got to know this. You got to know this process, guys. There is no way to pass the auditing exam without knowing this process. Any question? Okay, good. Then let's go ahead, if there are no questions, and let's just take a look at that one little thing there from the outline that said covered later, okay? And I said, hey, it's IT environment where substantive procedures alone would not be sufficient. Then you may have to test the controls, okay? And that's down here, effect of information technology. Okay, let me go ahead and put myself back into full screen here. Okay, so what happens here? Well, now we're sitting here and we're saying, look, if you're auditing an entity that has a highly automated environment, then they're not spitting out a bunch of documents that you're going to be able to come back and look at the end of the year. Computer storage is highly expensive. Excuse me, my eyes bothering me here. Sorry, guys. I was on an audit. We were looking at the Federal Reserve. And we were looking at how the Federal Reserve helps the federal government to auction. I was on the auction cycle, but auction, issue, and service, and then redeem Treasury securities. So the Federal Reserve banks do that as a fiscal agent for the federal government. So when we're doing the audit, we're thinking, well, at the end of the year, we're going to ask for all this documentation from you, Federal Reserve Bank. And Federal Reserve Bank says, no, you're not, because we purge our system every 7 days. Because the volume of transactions are such that it's cost prohibitive to have storage to be able to store every single transaction, right? So many entities face this. So information that happened in January probably ain't going to be there at the end of the year. So you may need to test IT controls because of the limitations that you're going to have in your ability to gather the evidence that you need to support the opinion. Or you could do some of these other things that are mentioned here. And the classic one would be, hey, do your procedures throughout the year. Come back every month and do some of your audit procedures in January before they purge that data, whatever. But an IT environment could be, they say covered later right here, could be the reason that you may have to test the controls, because you can't just go purely to a substandard approach, because the data that you would need to support that opinion may not be available in a fairly short period of time. Okay, question. Very important, guys. I wouldn't make a couple slides there, just for fun. So I have those additional slides. I absolutely need you to understand that. No questions? Okay, good. Now, when we think about financial statements, I know that we say financial statements, the balance sheet, and the balance sheet has assets and liabilities and stockholders' equity, and we attach numbers to those line items on the financial statements, and then we look at revenue, we look at expenses on the income statement, net income, we attach numbers to that, statement of cash flows, numbers, line items, okay, on the financial statements, right? That's the way we have always looked at financial statements up until now. Now we're looking at financial statements as a set of management assertions, okay? They are claims made by management about various things. So if management puts down assets, $1 million, well, they wouldn't say assets, but they'll say cash, $1 million, okay? They are asserting to you that cash of $1 million exists somewhere, probably in the bank. Okay, if they say building $10 million, they are asserting to you that there is a building that exists that is worth that they paid $10 million for. They are asserting to you that they own that building because maybe they're just renting or something, et cetera, right? So there are various assertions that they're giving to you. They say liability, 10 million. They're telling you that they have liabilities of only 10 million and there's not some more floating around out there. So the liabilities are complete. So we start thinking of financial statements, not so much as numbers, but as assertions by management, okay? Now, we have these 6 main assertions, okay? And you are going to have to know how to audit these assertions, okay? Now, they give you this mnemonic, which I don't care for, COVERU, cover you. You can use that if you want, but I need you to flashcard these assertions. That says flashcard, I guess. So we're looking at FC. Okay, flashcard. Okay, I need you to flashcard these. Okay, I need you to flashcard these. I need you to know these assertions. Okay, but more than knowing these assertions, I need you to know how to audit the assertions. Okay, so let's just stop for a second and let's talk about assertions for a second. Okay, and let's say we have the financial statements, right? Okay, and then we have what? Supporting the financial statements, the GL, right? And then supporting the GL, we probably have some subsidiary records. And then feeding into the subsidiary records, right? We also have some journals. My favorite journal is the sales journal. Okay. And then supporting, say, the journals, right? We have various records. For example, in the sales journal, supporting the sales journal, we'll have what? Documents. Anyone want to think of a document that might support the sales journal?
Invoices?
Good, excellent. Sales invoices, good. Okay, and what? Maybe they have one.
RMA return.
Number one, and maybe invoice number one, we'll say is for 100,000. Invoice 2 is maybe for 200,000. Invoice 3 is maybe 300,000. Right? Okay, good. Did I hear something else that's going to support the sales journal?
Or RMA return.
Okay. I'm not following you. You would enter returns into the sales journal?
We
Okay.
sell, but then the return, can we have like credit memo?
Okay. Okay, good. Okay, what else? How about shipping documents? Right? Because if we had a sale, there should be a shipping document, right? So we got shipping document 1, and let's say we have sales invoice number 15 down here is for 17 million. And then we got shipping document number 1 for 100,000, and we got shipping document number 2 is 200,000. Shipping document 3 shows that 300,000, and then we got shipping document 15, let's say down here for 17 million. Okay. Okay, good. Now what happens? We see the sales journal, and the sales journal has 100,000 in there. Sales journal has a sale for 200,000. Sales journal has one over here for 300,000. And then there's one number 4 over here for 500,000. Okay. Now, what the auditor is going to do is they're going to pick, we won't have to look at every single one of them, but they'll pick something from the sales journal. They'll find the sales invoice. They'll find the shipping document that shows that that was shipped. Are you, as an auditor, satisfied that there was 100,000 for sale for the sale number 1 that was entered in the sales journal? Are you satisfied with that first entry? I'm going to start here, and I'm going to go and find these documents. And of course, we're making sure that the journals reconcile to the general ledger. General ledger reconciles the financial statement. I mean, you know, when you look at procedures sometimes that are written in audit textbooks, they act like this is the key procedure. Reconcile the financial statements of general ledger, subsidiary ledger, journal, and they call that out as, you know, some big step. If I can't reconcile the financial statements to the GL, the audit is over. I tell the client, here, take your stuff back and go figure out what's going on. I mean, they have to have a system that can reliably generate the financial statements. So once I see that all that reconciles, I'll probably start with my journals. And I'm starting with the journal, and I'm going and finding the supporting documentation. I'll even put the word supporting documents. It's supporting the things that are in the journals. Okay, so again, are you satisfied that that first entry in the sales journal was supported? That's a question.
As long as it's recognized in the proper period, I would say yes.
Okay, well, we're not talking about cutoff procedure at this point, but that's a good answer, because I'm doing one procedure for a particular assertion here. You do different procedures for different assertions. So assuming I'm not worried about the cutoff assertion right now, yes, then for what assertion do you think this is then? If I'm saying that it's not the cutoff, then what assertion is it?
Existence and accuracy, maybe?
Well, accuracy is not necessarily an assertion, but existence for sure. That's existence, isn't it? Hey, look, that sale existed because what? It was recorded in the sales journal. I went over, I found the sales invoice, I found the shipping documents, I found supporting documents that I was satisfied with, right? Okay. Now I can do the same thing with what? With this number 2. Okay, well, audit procedure work for that one. Then I go ahead and I try what? I try this next one. The what? The 500. Oh, that's not going to work. They don't have an undo on this. Oh, I guess I could have erased it. Okay, we need different colors. So I'm going to do, I'll do this gray. I guess you could see that. And if you can't see the gray, I'm going to give up. Okay. On the color thing. Okay. So I come over and I see this one number 4. Do you see number 4 in the supporting documents?
No.
No. So I go to management and I say, management, we pulled a sample. We pulled this entry in the sales journal number 4. We tried to find the supporting documents and we couldn't find it. How come? And they say, oh, thank you. Thank you, auditor. You know, Bob used to do that all the time. We fired Bob because he used to make that kind of mistake. He'd enter some of the sales journal and no, he never shipped the goods or there was no invoice for it. So did we find a misstatement?
Yes.
Found a misstatement by testing for the assertion. They call this directional testing. When you go from the accounting records, which is the sales journal, to the supporting documentation, the blue here, you just tested the existence assertion. Okay, good. So then we decide, well, we want to test another assertion. And this time, we're going to start from the supporting documents and we're going to come back to the financial statement. So now the arrow's going this way, right? Okay, so we find the shipping document, we find the invoice, we take it back to the sales journal. That is the completeness assertion. Okay, the sales journal is complete. The things that got shipped, again, I'm not worrying about cutoff now. The things that got shipped this year, okay, in the correct year, the things that got shipped, they got correctly included in the sales journal. So I've just proved completeness, haven't I? Okay. Now what happens if I come over here, you see this one for 15,000, for 13, what did I say, 17,000, number 15. And you go and you see the shipping document, you see the invoice. Is it recorded? Is it recorded?
No.
No. So now I'm saying, hey, wait a minute. What happened? You shipped something for 17,000. You had an invoice for it, but it never got included in the subsidiary ledger. I mean, excuse me, in the journal, in the sales journal. Well, oh, that was Bob. He used to make that mistake too. Okay. Now at this point, maybe my professional skepticism is starting to light up a little bit because who is this Bob and where is he and what kind of other errors did he make? And maybe I'm going to respond to that by making further inquiry or expanding my sample, etc. These things kick in as you start to find an error. Okay. So when we're dealing with completeness, we go what? From the supporting documentation back to the financial statements. Okay. So we're going to talk more about assertions as we go through. Okay. But it is not enough to know the assertions. You're going to have to know how to audit those. Okay. And we would have other procedures that we would perform for these other assertions. And where we're going to really talk about assertions is more in how they relate to each account. And a mistake that candidates make when they're getting ready for the CPA exam, they start to boggle their mind trying to memorize all the procedures that you're supposed to do for the different accounts. No, what we know how to do is audit assertions. And you already know how to audit 2 of the most commonly asked assertions, which is existence and completeness. For existence, you do what? Start with the financial statements, go to the supporting documentation for existence. For completeness, you do what? For completeness, you go from the supporting documentation back to the financial statements. Okay. Cutoff, we're going to look at transactions near year end to see if they were included in the proper year. We'll talk more about that. Someone mentioned accuracy, but accuracy is the dollar amount correct? So even though we're seeing that it was 100,000, we would still want to do some steps for accuracy. For example, yeah, they send out the invoice for 100,000 and they sent 10 items, but each of those items had an amount of 100,000. So that invoice should have been of 100. So that invoice shouldn't have been, now I lost myself. What was the number? 100,000. Each item on there was, one item for 100,000, but really the item should have been 1 million. So you would probably want to look to make sure they extended it correctly, that sort of thing. I'm not giving a very good example there that you would need to do for accuracy. Okay, existence from the financial statements to the supporting documentation, completeness, supporting documentation, back to the financial statements, rights and obligations. Even though you can see that an asset exists, right? You looked at the asset, here it is. They have this asset. You went and looked at the asset. You went and found it. You saw it on the financial statements, and then you went and found the asset. Yep, it exists, but do they own it? Do they have the rights to it? So you would do one procedure for an asset for existence, finding the item in the subsidiary records and going and walking the floor and finding it. Another procedure to do what? To see if he actually has ownership. So now you'd ask, hey, can I please see the invoice? Oh, you know what? We didn't actually buy that. We're just renting it. So you determined rights that way. Okay. Understandability and classification is really getting to have they put it in the right place in the financial statements. Yes, they're putting down cash, but the cash is restricted. And if the cash is restricted, they need to footnote that restriction. They need to give information about that restriction. Okay, so different assertions, different procedures. Now, we have to flashcard the procedures, the assertions, we have to know what they are, but we also need to know what category these assertions fall into. So we have 3 categories: transactions and events, account balances, and presentation and disclosure. Okay. Now, transactions and events generally deal with the current year. So it's probably stuff that's going to be reported in the journals. Okay. Now, when you look at the assertions here, they tell us what? Relevant assertions include completeness. We just saw that. What? Include occurrence, right? We saw completeness. We saw existence and occurrence are sort of synonymous. You call it occurrence when you're dealing with the current year. Okay, existence and occurrence. Okay, cutoff. Okay, that's the whole point of cutoff. Did you record it in the correct year? Okay, accuracy. Did you record the amount correctly in the current year? And again, you probably have to do some different step other than just the directional testing for occurrence that we talked about, going from the financial statements to the supporting documentation. And then classification. If there's something that needs to be footnoted about that, then we would want to make sure and check the classification, see that there's a footnote there. Okay. Now, for account balances, it's going to be all years. And we're probably talking about our ledgers. Okay, for example, that says ledgers. If I purchased an asset 2 years ago and the asset has a 5-year life, should it still be in my ledger?
I'm sorry. How long ago did you purchase it?
I don't know. I don't forget what I said. I
Two.
purchased it it has a 5-year life and I purchased it 2 years ago.
Yes.
Yes.
Should still be there. It should still exist, shouldn't it? Okay,
Yes.
so for account balances, it's not things that are going to necessarily be recorded in my journals. It's stuff that may be sitting in my ledgers, right? Okay, and so let's look at the relevant assertions there, which is what? Relevant assertions include completeness. Yeah, we want everything that should be there, that's still there, to be included, right? We want all the assets that are there. So we're going to find the asset. I'm hitting this printer over here that you can't see. I'm going to find this asset and I'm going to go over and do what? See that it's still included in the ledgers because they still got it. Okay. Includes what? Includes existence. Includes valuation. Hey, maybe I've got an asset that's obsolete, like this printer. I should probably throw in the garbage, right? Okay, but whatever, I still got it. It still works. Shh, don't tell it I said that, okay? Because I still use it. But what happens? You sit there and, hey, that printer is obsolete. You need to write that down to 0, right? Okay. Existence, hey, it says here you got a printer. Then you go and you find it. So you can still do directional testing, but now it's for an item that would constitute an account balance. Allocation, okay? Did you depreciate that item correctly? Okay. Rights and obligations. Hey, you got it, but do you own it? Can you show me an invoice that says you bought it? Oh, that's right, we're only renting that stuff. Okay. Different categories, different assertions fall into different categories. Notice, cutoff does not fall into account balances. Cutoff is related to what? The correct year. Was it recorded in the correct year? And that's relevant to what? Transactions and events, because they relate to the current year. Okay. Presentation and disclosure is really talking about footnotes. Did you put things in the footnotes? Did you disclose things that you're supposed to? Okay. So now notice, are your footnotes complete? Are they what? Understandable? Did you classify things correctly? Did you disclose things about rights and obligations? Let's say we have pledged our accounts receivable as collateral against a loan. Well, we would still leave the account receivable on the financial statement because it still exists, but you would do what? You'd come down to the footnotes to see that you called out the fact that there's a lien, so to speak, against those accounts receivable if you pledged them as collateral. Valuation and accuracy. Yeah, I'm telling you that my marketable securities were quoted at this price at year end, but here was the original cost or whatever. And you start to disclose different things about valuation accuracy. Okay. All right. Now, make sure you flashcard the assertions and make sure you flashcard what categories they fall into. Okay. By the way, for rights and obligations, if you go back up, well, you could just do it that way. Just flashcard it there. There's a little bit of a discrepancy on the next page, but I think if you flashcard the assertions and what categories they fall in here, you should be in good shape, and just flashcard the assertions. And more importantly, we're going to building our understanding as to how to audit the assertions. Okay, so let's look at that. Let's come down and let's look at use of assertions. Okay, and this is the key thing. It's not just knowing the assertions, it's knowing how to audit them. So an auditor uses assertions to determine the audit procedures that you need to perform. And what the auditor thinks about is this notion of potential misstatement. Okay, so the auditor thinks about potential misstatement, looks for controls that'll prevent or detect that potential misstatement, and then designs the audit procedure around that. So you come over here, and this is somewhat truncated, but let's just go ahead and let's look at this thing for a minute. So we're talking about inventory. The assertion is exist. Okay. Now the potential misstatement is that an inventory balance includes amounts for inventory that do not physically exist. So what would be the audit procedure? And I don't like this because I feel like they kind of copped out a little bit. I'm going to put, well, the audit procedure would be to do what? Go from physical inventory. You know, I've only been teaching this for 30 freaking years and I make that same mistake every time. Go from accounting records to physical inventory. Would that be a good procedure for the existence assertion for inventory?
Yes.
Huh?
Yes.
Right? Here it is in the accounting records. Go find the inventory item, weird star, whatever this thing they put here. I have my house on the market and they start staging the house now. What is this thing? I'm supposed to throw this at somebody? Okay, so what happens? You sit there and you do what? Weird star is on the accounting records. You go find it. Here it is. I just proved the existence assertion, right? Okay, let's try completeness. Inventory balances include all inventory items on hand. What's the potential misstatement? Inventory items on hand are excluded from the inventory balance. And again, they say observe the inventory. Let's go ahead and be a little more precise about that. Go from physical inventory to accounting records. It says accounting records. So now what? Okay, here's a stapler. Let me go and see if I can find, oh, there it is, stapler in the accounting records. I just proved the accounting records are complete because I found the stapler and I came over here. Okay, so we design our what? Procedures around the assertion. Now this table is somewhat less sophisticated than the whole sort of thought process that I need you to start to understand now while we're talking about assertions. Okay, so I'm going to go back to those slides and I'm going to put this one up right here. Okay, and I guess I better go slideshow mode for this one because it's a little hard to see otherwise. Okay, it's still hard to see. So guys, you're going to have to get a little closer or something. Okay, all right, so what happens? The full way that you're supposed to look at this is to say, look, I have an account. I want to audit this account. I'm going to audit sales. Now, if I'm auditing sales, I need to say to myself, well, maybe I can get evidence about sales and another account that's related to sales at the same time, or vice versa. So I'm going to pick accounts receivable as my account that's related to sales, right? Debit, accounts receivable, credit, sales. And the assertion that I'm testing in this example is existence occurrence. So I think of a potential misstatement, and this is one of the few times that the auditor gets to use, and an accountant as a CPA, you get to use your imagination. Use your imagination. What's the potential misstatement? Potential misstatement in the assertion is that a sale is booked, but goods were never shipped, or as somebody alluded to, there was a return, but they never booked the return. Okay, therefore the sales didn't exist. Okay. Now, what I do and what wasn't in the table that we were looking at in the book a minute ago, they didn't talk about, well, then you evaluate the internal control. And so I would look at the internal control, and I look at the internal control as how well is it suited to prevent or detect the misstatement. Okay. A control has to be well suited to prevent or detect a misstatement. By analogy, the reason the coronavirus was so bad was that they called it the novel coronavirus. It was because it was a virus that didn't really manifest itself before. And so what happened was our immune systems were like, what the hell is that thing? And so what our immune systems would do is just kill everything, healthy tissue as well as good tissue, to try to get rid of that. And that's really, it's not the virus itself that kills you. It's the immune system trying to properly respond to that virus and killing good stuff that unfortunately ended up killing a lot of people, right? Okay. The way the immune system is supposed to work is you may have those killer cells happening at the beginning, but eventually your body is to dial up the proper cells that through ages of evolution, the proper antibodies, I should say, through years of evolution, are specifically designed to click on to that virus and gently carry it out without killing everything and making you deathly ill, okay? So you can think of the internal controls that way, and that we're not looking for killer cells, internal controls. We're looking for the internal control that is well suited to prevent or detect that particular misstatement and that particular assertion. We're sitting there and saying the potential misstatement and the existence assertion is they booked too many sales. They booked sales, but they didn't ever ship the goods. So we look for control that'll help prevent or detect that. Now, in this particular case, I said the individual that computed the sales order and submitted the sales order follows up with the customer's satisfaction of goods. So they call the customer and they say, did you like those widgets we sent you? And if the customer says, no, I didn't get those, then maybe we find out that the sale didn't occur. The problem with this control technique, though, is it's what? There's no good separation of duty. It's the same person that filled out the sales invoice also calls the customer. Well, that person that filled out the sales invoice may be trying to increase their commissions or something. So I have to do what? I have to, on every engagement, I have to do what? I have to obtain an understanding of the control technique, and I have to assess the risk of material misstatement. So now I'm tying this back to those arrow slides we had a minute ago. And in my assessment, I say, control risk is at the maximum. I don't like this control. There's not good separation of duties, and the operating environment in the entity is very competitive. They're in a competitive industry. So I'm not happy with this control. So what happens? Well, if I'm not happy with the control, if I assess the control risk at the maximum, when I move to the testing phase, I bypass the testing of the operating effectiveness of the control. And now I go directly to the substantive test, and I do a substantive test that's going to help me with the existence assertion. So what do? I pull a sample of accounts receivable from my client's subsidiary ledger. I send out confirmation letters asking them, hey, did you buy this stuff and do you owe $10,000 or whatever it is? By doing that, I get evidence to support. They say, yes, I did buy that stuff. Then I get evidence to support what? The existence assertion. What did I do? I went from the financial statements, the subsidiary ledger, pulled the name of my client, and sent a confirmation out. So I went from the financial statements to the supporting documentation. The supporting documentation is really a person, my client's customer, who's sitting there and saying, yes, I owe that. Okay. Now, this table is mutually exclusive in that, you can't have both, right? We still have sales, we still have accounts receivable, still have the same potential misstatement as when our control risk was at the maximum. But now we look and we have a sales manager making the call, and they confirm the satisfaction, and the manager signs off on a call log, and the call log is forwarded to the internal audit, and internal audit staff follows up monthly on random sample calls to reconfirm information entered into the log. So now I've got separation of duties, and I start assessing the control, and I say it's low. The control has operating effectiveness because what? separation of duties. I did a walkthrough. The person seemed to understand what they were doing. I followed up with the sales manager. They seemed to know what they were doing when they did the calls. I participated in calls with the internal auditors because internal auditors sometimes can help you in that way. They're brethren auditors, and you may be able to work with them in certain situations to get some additional belief about the operating effectiveness of the controls. Since I thought the controls had operating effectiveness, I set the control risk at low. Now I have to test the operating effectiveness. And so now I get a sample of those call logs, and I look at those call logs and I see that they were signed off on, etc. And after I do all that, then I don't have to do as much substantive testing because I've gotten some comfort level with the internal controls by all this other work I did. Okay. But notice the key takeaway from all of this, and we'll talk about this more, is what? This process more. But the key takeaway is I picked an assertion and I thought about a potential misstatement, and I designed the rest of my audit procedures around that potential misstatement. And it looks like I might have clicked something so that this is now automatically running. So let me get out of it before it drives me nuts. Question? You got to know this stuff, guys. This is the auditing exam to a large extent. I mean, everything kind of flows from this. Question? Okay, good. So let's go ahead and look at a couple more things here and note that a given procedure may provide evidence about more than one assertion. Okay, that's probably not so much the case as what? More than one procedure may be required for an assertion. But generally what happens is what? You have an assertion, you have a procedure. You have an assertion, you have an account. First, God created accounts. Then God created assertions, right? So you have an account, you have an assertion, you have a potential misstatement in an assertion, you have an internal control to prevent or detect that assertion. A auditor evaluates the operating effectiveness of that control, and then potentially test that control, test the operating effectiveness if the auditor likes the design and implementation of that control, potentially test the operating effectiveness, and then design your substantive procedure. Okay, remember the audit plan must be written. So let's go ahead and let's take a look at a couple of questions here. Careful, guys. Know where you are in the audit. Don't be lazy. Don't look at that first answer and say, that's good enough. That is not the way to approach the CPA exam. You need to look carefully at the question. You need to look carefully at the choices and pick the best answer. Do not ever look at that first choice and just pick it. And as rapidly as some of you picked A, it's clear to me you didn't read through the rest of those choices. So when I sit in my office, I look out to my backyard and I've got like this kind of nature area back here. And every day I see a crow and a hawk. And I'm not sure if the crow is trying to kill the hawk or the hawk is trying to kill the crow, because sometimes I see one chasing one, sometimes I see the other chasing the other. And every day, this crow and this hawk got to go through this. Now, would you want to be them? No, we don't want to be the crow and the hawk, but we need to do our part in nature and be relentless about how we go through answering a question like this. There's no, oh, well, let the crow kill me. Let the hawk grab me. It's okay. No. Okay. The examiners are the hawk or the crow here, and we're going to fight them every day till we get the right answers on these. Okay. So you take a look at this question. Okay. And I'm just going to go ahead, and most of us, got it right. Most of us are crows or hawks or whatever. Okay. But let's go ahead and let's look at this. Okay. So what happens during the initial planning phase? Is initial planning phase the beginning of the audit or the end of the audit? That's a question.
Beginning.
It's the beginning of the audit. Good. So what are we most likely to do at the beginning of the audit? Again, we don't want to get killed by the examiners on this question. Okay. So at the initial planning, at the very beginning, is that when we're going to identify specific internal control activities that are likely to prevent fraud? Maybe, but is there something that we're more likely to do at the beginning? Evaluate the reasonableness of the accounting, reasonableness of the client's accounting estimates, which no one picked that, because your sense is, hey, that's not initial planning. That's something that you're doing as you're wrapping things up and looking at estimates. You've got satisfaction about some of the numbers, and you're going to do some reasonableness tests, maybe some analytical procedures, not in the initial planning. Okay. D, inquire of the client's attorney as to whether any unrecorded claims are probable of assertion. At the beginning of the audit, in the preliminary planning phase, you're going to start sending letters out to attorneys? No. Are you likely to discuss the timing of audit procedures with client management? That's when you're doing that kind of stuff. Look, we're going to have to do some testing potentially at the year end. Potentially, we're going to need to come in at interim dates. We're going to do a midnight inventory count. These are the kinds of things that you discuss with management and put in that, and potentially even put in that engagement letter if you need to. Okay. So you need to fight with these questions, guys. There are no time that they're going to give you. You think the examiners are sitting up there saying, let's see, how can we get more people to pass this exam? Okay. Question? Okay, good. Let's take a look at this one. Okay, guys, go ahead and make your best choice. And yeah, I like that. I like that. I could almost hear you thinking through that question. I could hear you going through that process with that question. I could hear you fighting the crow. Okay. So you take a look at this one and let's just look at it. Okay. But I could hear you going through that process. I could see the time you were taking. Beautiful. In developing an overall audit strategy, what does that mean? That means that we're at the very beginning, overall audit strategy, right? We're not thinking about minute details at this point. Overall audit strategy. What are we going to do? Whether the allowance for sampling risk exceeds the achieved upper precision limit. Does that sound like an overall strategy? No. Findings from substantive test performed at interim dates. Findings were what? Considering findings from substantive tests after we've already gotten past overall audit strategies, right? Whether the inquiry of the client's attorney identified any litigation claim assessment, that's towards the back end of the engagement. You're not going to do that at the very beginning. Preliminary evaluate, the word preliminary goes nicely with what? With overall audit strategy. Yeah, we got that. And we do that in the overall audit strategy phase. That was right out of the textbook. I gave you a flashcard on that too. So that probably helped too. Flashcards help with that kind of stuff too. Okay, all right, good. That's a good note to finish on, guys. That's the way you need to start building that muscle tissue. If you go through and you look at these questions, don't just sit there, oh, let me guess and let me try to get through this. And, no, that's not how you do it. You are fighting through every single question. You start that here in class. You continue that when you're doing your homework. Continue that when you're doing the final review so that you walk in a multiple choice question answering machine. You are a finely tuned athlete that's going to knock those questions on their ass. Okay? All right, guys, good work. I will see you on Wednesday. Unfortunately, we weren't able to. We did. All right, is the next module? Yeah, okay, so good. So you should be able to look at module 4 up through module 4 for chapter 2. Okay.
I got a question.
Yes,
It's like it's an individual question. It's not for the whole class, but I got the email from California.
Hang on, because I don't like to get personal discussions on the recording.
Okay.
Okay, so I'm going to go ahead, Travis, hang on. We'll have plenty of time to talk. I'm going to end the recording. I'm going to conclude the class, okay, and then we can talk.
Thank you.
Because I post these on YouTube, and I don't want the whole world, with any information that may be personal. Okay. All right. So let me go ahead.